Hi student, good day. Welcome on Strategic Business Reporting paper. We assure you pass success in first attempt if you watch the full recorded lectures, attend our revision classes, follow ACCA past paper and its marking scheme, prepare for mock test, then you are just away from your success. Absolutely, this is true. This paper can be passed in first attempt even you are just a month preparation and you just get ready for the exam. If you have done previously good attempts in your like F7 F8 and SBL, if you have passed gone through all these paper, SBR strategic business reporting will be a easy touch, that is the for sure. So these techniques, passing tricks and tips we will discuss. Each chapter have some different tricks, and there are techniques which you need to follow, which I keep sharing with you. And during the lecture, during each topic, you definitely find tips for your success. Okay, today first chapter is about frameworks. Before starting this one, I just give you a brief intro about myself. I am Farooq Ahmad. I am ACCA. I have done my ACCA from Dubai through Phoenix Financial Institution. So they provide excellent high level of teaching services. So actually, this team is from Kaplan. So the same strategy I follow, and I have started my own sessions for recording lecture for the ease of the students, because I have seen a lot of expensive tutorial are going on here and there without naming anyone. So I am offering you best of my services online for helping you to pass your paper in first attempt. And by just taking a few revision classes with me before exam, you definitely you can pass through your paper. Our paid student will get this Kaplan study text, their revision kit, pass card, and integrated workbook as well. So where we offer online recording of the lectures, live revision kit. Practice is about 30 hours through Zoom. We will manage the last 15 days of before exam. We start preparing students, and they definitely get through. With we provide WhatsApp support as well, and this study material which we have mentioned will be provided to the students. So let's jump into the chapter 1. The chapter 1 is discussing about a strategic business reporting for the purpose of the framework. So there are our first beginning series will be for up to 10 chapters, starting from the chapter 1 frameworks. So then it will follow with the other chapters which are in Kaplan, and this is the same series, the same style. Even if you are following BPP or ACCA, any other recommended books. So chapter learnings are also there. So what objectives are available which you will achieve by after going through this chapter framework. Actually, framework discuss about the importance of conceptual framework, how it is providing you the guidelines, how you can follow with the production of accounting standards. So it is the main framework which where, because this is the last paper of your ACCA in accountancy, which preparing you now for as a chartered accountant. So because you are future chartered accountant, and now you are getting ready, institute is preparing you to get ready for this professional way of presentation, same like CA or other chartered accountancy qualification. So this will be it's a very much wider topic. So you have to prepare yourself for these all understanding of these chapters and these topics. So this is understood because you have earlier learnings also from F7, F8, F9, even SPL. So you will have to utilize those experiences over here in this paper. It discusses about the qualitative characteristics of useful financial information, evaluate the principle of recognition and derecognition and measurement, including the measurement of uncertainty. We discuss all these areas one by one. Critically, we will discuss about the how to apply the fundamental principle and element of the financial statement in the financial reporting area, how it is presented. Evaluate and apply the principle of fair value measurement. We will discuss fair value. That is a very easy and interesting way of presentation. So you will find every topic very easy way, so which you have to remember. Some things you have to memorize, and most of things we will clear it. Okay, now this is the conceptual framework. See, this is a very easy way. As I explained, the conceptual framework of financial reporting is just like we have to follow the materiality and the fair value measurement. So this is the main thing which we need to follow and understand and adhere by these principles. About this chapter, conceptual framework is used for the purpose of the board of directors, how we present a financial statement to them for any of their decision making or any for their future planning, and how it is helpful for them to understand in the short way or the easiest way, with the complete transparency and complete accuracy of the information. The purpose of conceptual framework is as we discussed, is for the assistance of board when the developing IFRS standard, helping to ensure that these are the based on the consistent concept. Prepare financial statement. This is the main thing. So for you, for how it is financial statements are prepared, and how this is the standard rule will be applicable to the particular transaction, and which IFRS standard offer a choice of the accounting policy. All parties, when understanding the interpretation of financial reporting standard, so this is understood that every party and every stakeholder have to understand the IFRS standard. So how it is how is meant to introduce about the detail of the project or any concept or any financial instrument which we discuss. Everyone should be familiar with the conceptual framework, because it's not an accounting standard. It does not override the requirement of particular IFRS standard. Conceptual framework is a simple way of understanding and presentation which need to be followed, because this is a conceptual framework. You will see each and every accounting body provide almost the same way of presentation, because this is the one how you will find if you see any financial report, balance sheet of a UK company or a USA company or any Indian, Pakistani or Dubai based company. So their presentation way of the presentation, financial statement, balance sheet, income statement, everything everywhere is the same way. This is a practice of financial presentation of the according to the framework. So this is the way how you find everyone is presenting their reports in the same professional way of the accountancy. See, in the same manner, if it is a financial statements are prepared in the professional way as the framework defined by ACCA or other financial body, if investor also want to see their results, or creditor or any stakeholder want to see, they are going to make it helpful for them to make any decision. Like if company apply for any financial facility from the bank or any financial institution, it will helpful financial statement helpful for them to make their analysis, their ratio analysis, their profitability, how their assets turnover, or the all ratio analysis. So they will find it very in accurate manner, because this is a comparative statement, like last year's financial statement, current year financial position. So they have to present it, because this is a part of financial framework. So for easy way for you to understand about the framework point of view, you just go through, if you are working, go through your annual account, see your audited report, you will find all these way of presentation in the same manner how this is today we are discussing in this chapter. So for your complete and detailed understanding and detailed review, I recommend you to have a complete course and join for a revision and get your textbook and study text and revision kit and all study material for your easy reference. So it will helpful for you to just for your free time readings also, it will be helpful. This is a summary of content of the conceptual framework. So what is a concept is talking about the measurement, measurement of any transaction of, if any like if company purchase any asset or any part of the equipment or any as liability or any financial transaction is going to happen. So how it is measured? So first of all, it will define how it is going to present this in the financial books of accounts, how long is a life, how this is nature of the product, what is expiry of this product, elements of this product you will need to identify, like as a group meetings in financial or auditors meeting, so they will keep discussing on this evaluation or of the element. Then recognition and derecognition, so they will see, so to recognize this in your financial statement, if how recognition mean, this is all now prepare, recall your past learning, F7 learning, you should bring it up here. So recognition of financial assets, how you recognize in the financial statement. So this is we will keep discussing in later chapters. Qualitative characteristics, the financial statement, and then useful information about this result of this conceptual framework. Then aggregation, presentation and disclosure. So this is an important thing. This is presentation and disclosure. As I told you, you just refer to your audited report, you see their presentation and disclosure at the bottom of their financial statement, their disclosures are there. So they, whenever they feel some auditor feel some thing need to be notified to the investors or other stakeholder, so they make it present it in their financial statement at the bottom or at the end of this statement. Fundamental characteristics of conceptual framework, which is very useful if it is relevant and a faithful representation. So relevancy is a most important thing. So what does that mean by relevant? Is information to make an impact on the decision made by the user on the financial statement. So this is important to understand and to grab this topic. So there should be a relevant of the transaction. Relevance should be there about any transaction which is going to impact on the decision made by the users. Readiness require management to consider materiality. An item is material if omitting, misstating, or obscuring it would influence the economic decision of the users. So mean to say, if anything in other way around it happen or materially it is not accurate, so then the relevancy will affect. So it need to be identified with the complete care and complete responsibility and transparency of the transaction. It have to be presented. Faithful presentation. Faithful presentation is that the one which is presented by the auditor. This is their responsibility. So the information will be complete, transparent and faithful. A faithful representation of a transaction would present the economic substance rather than its legal form. The perfect faithful representation would be complete, neutral, free from error. So it should be a complete, neutral and free from error, and it should be in professional way. Financial statement and the reporting entity. The financial statement conceptual framework, as I discussed already, so it's work around this all part of the financial statement, like assets, liability, equity, income, expenses, and the information is provided a statement of financial position. then statement of financial position performance and other statements such as a statement of cash flow. So these are the financial statement part of the statements which require according to the framework. So you as whatever you study earlier, so those now they are bringing it in the order, in the manner how you are going to represent it as a complete audit report. Reporting entity. So reporting entity, again, this is a part of if there is a group of companies, so they will identify which company is a reporting entity, like head office, like a corporate office, or the holding company is a who is holding the main shareholding, where they are having the majority of the shares. So they will identify according to the board, according to their auditors. So they will keep discussing and keep understanding the whole need for the department or the company, whether it is a subsidiary or associate company. So we will discuss in detail more on these examples, how it is going to affect their company's position. If reporting entity having a less stake, then it is like become like an associate. If they have a minority share or the major share, so then they will make it in the consolidation. How all these things will affect, it is a part of your framework, and how it is a framework you need to make a in the professional way of presentation. Now again, they discuss in the financial performance. What are the element of financial statement? Is a asset, liability, equity, income, and expenses. So these are the very normal things which are very easy to go. But as a part of theoretical point of view, you have to understand from how it is, how they are making you to make a presentation. If it is asked as a objective type, or as a 2 mark question, or a little bit theoretical question, so you can present it in the professional way, like a professional under the definition of IFRS, you will define it like asset, a present economic resource controlled by the entity as a result of past event. So whatever is a past event, asset, definitely you have since last many years you have that assets like machinery, equipment, or car or vehicle, whatever is there. So you have a asset like a past result of this event. So the liability is also present obligation of the entity to transfer an economic resource as a result of a past event. This is the same way. Equity is a residual interest in the company. Then income, increase in the assets or decrease in the liability that result in an increase to equity excluding contribution. This is a simple definition of this income. Expenses is the same way, how this is a decrease in the asset or increase in liability that are result in the decrease in equity excluding distribution into equity holders. So then contribution from and distributions to equity holders. So this is the exchanges of assets and liabilities that do not increase to or decrease. So we will discuss in more detail. So then this is our next thing they are talking about, this derecognition. So derecognition needs some little bit understanding, more detail for you. So what is the derecognition? What is this? Is opposite to recognition. If you recognize some assets in your financial statement, so the same way it will go like for derecognition. So how you are removing some assets from assets or liability from the statement of financial position. Derecognition normally occur when entity loses control or of the asset or has no present obligation. So like if the company sell out their vehicle or machinery or equipment, so they lose the control. So ownership is a transfer. So the complete risk and reward transfer. So this is all definition things of the relating to particular assets or liability they fulfill. So this is then it is a steps for next step for derecognition. Accounting for derecognition should faithfully presented to the change in the entity's net assets as well as assets or liability retained. This is achieved by derecognition by transferred, expired, or consumed component. Okay, that is understood. Recognize a gain or loss on the above. Suppose if your book value of your asset is $5,000 in your book of account, and at the time of sale you sold it for $6,000. So you are just $1,000 is your gain. So you have to mention in your assets your other income. So sometime an entity might appear to have transferred an asset or liability. However, derecognition would not appropriate if exposure to variation in the element of economic benefit is retained. So sometime if it is a ownership they retains due to some certain reason, so that is or depend on the situation, on the case to case they will discuss, they will see. Students, if you have any type of questions you can comment it. If you are not enrolled yet, so you can comment on this video. We will definitely get back to you, or you have my WhatsApp, so you can message me if you have and if you still you are finalizing your steps for your joining our live trainings, live revision classes, and then before that if you have a question definitely you can get back to me, so we will help you. So it's not for only for paid student, for the just visitor also have questions, so they can approach me. So recognition and derecognition, again recognition items are only recognized in the financial statement if they met the definition of one of the element. However, not all meetings or these defines are recognized. Element are recognized if recognition provide users with the useful financial information. In other words, recognition must provide a relevant information, a faithful representation of assets or liability, and resulting income, expense, or equity involvement. If you buy equipment or like a generator unit you purchase, so you know this is a complete documentation is there, is relevant, is linked with your production, is the cost of production will increase, then your efficiency will increase, and your maybe some expenses will reduce. So this is all relevant things, so it is relating to your business. You are not buying a house for your residence, and you mention in your building company use building. If it is not fulfilling this purpose, so definitely relevancy should be proved. Auditor need to verify all these rights. Okay, recognition might not provide relevant information if there is an uncertainty over the existence of the element, or if there is a low probability of inflow or outflow of economic resources. As I said earlier, if it is a assets is for a house purchase, and this is for their director use, this is it has a question mark. If any vehicle is purchased and booked in the company accounts and used for a private purpose, then again it is depend on their nature and depend on their facilities whether they it is a part of a company obligation. So they have to clarify. So the auditor have a right to ask this type of question, because you are a future auditor, you are going to future CFOs and future accountants. You need to verify these items with the stakeholder and with the decision maker. So you have to, because you are the one who is answerable for their all these obligations. So as a head of the department, or because in America, in UK, the CFO is responsible for all the financial activities. Even in Gulf they are responsible, so they have a legal obligation. So once you become a responsible person as chartered accountant, so this is your duty to make a complete presentation and complete verification of this uh, Okay, students, regarding presentation and disclosure, this is again once the auditor or the chartered accountant is satisfied with the nature of transaction, so they will have to provide a disclosure. The complete explanation is also required. So they need to inform the board for about the entity specific information is the most useful than standardized descriptions. And then duplication makes financial information less understandable or understandable. So these things very much important to take care. The classification of assets or liability into separate component may provide relevant information if component have a different characteristics to recognize financial statement. Elements must be quantified in money terms, like a conceptual framework outlined two board measurement bases, like a historical cost or the current value. This include fair value used in the current cost. So this is the next the topic is for IFRS 13 fair value measurement. So there you have to memorize this IFRS 13. What is the meaning? This is a full IFRS number and meaning. You, if you mention in the question, like at the time of answer, so if you make a correct writing on this in your answer book, you definitely get a half mark for presenting or mentioning your IFRS with the full name. IFRS complete. This is a tip for you to gain your easy marks. If something is coming, you have to write a relevant IFRS for that one. Whatever question, if it is relating to the question, whatever is asked, you answer it perfectly. So definitely you will, if it is a needed, if it is a required, so then you have to make it your answer plan properly. The objective of IFRS 13 is to provide a single source of guidance for fair value measurement where it is required by reporting standard rather than the guidance with the separate several reporting standard. Like many accounting standards require allow items to be measured at a fair value. Some example from the prior studies which shows about property, plant and equipment. IAS 16 is your interesting component. And the IFRS 3 combination, business combination, which require the identification net assets or subsidiary to be measured at fair value at the acquisition date. This is like your consolidation point of view. You have to very much careful at the time of this fair value calculation. So there is some topic IFRS 13 does not apply to the share-based payment, IFRS 2 share-based payment, or IFRS 16 for the leases. It's not applicable to them. Then definition of fair value, again it is coming to the extent. So how you define this fair value? This is also a part of your framework. So how you are going to define this fair value? The price that would received to sell an asset at the time of the transfer of the ownership. So what is the meaning of fair value? Mean like a fair value of your car, so your bike, your whatever assets belong to you as a personal level. You know, you bought it a year ago about 10,000, and then now its present value is 8,000. Mean you are losing 2,000, and this is a loss. This is like impairment. So if it is increased, so 10,000 asset a year ago you purchased and now is 15,000, this is a fair value. So now you will never sell it at 10,000. You will never say this is understood. And the financial auditor or financial accountant, they also need to verify this thing. So because once you have joined a company, so you are the part of the company. You have to take care of their assets, liability, their all financial items in the same manner. So like companies assets, so you have to consider according to standard. So you have to consider it for fair value treatment. So that it can be done by third party when pricing of an asset or liability. Market participant would also like a property valuation. So you hire a valuation company and make it. They will. This is their criteria about depend on the condition, location, and restriction of the use. So what are the criteria they need to verify? So this is a lot more. This is a study part is also there. You have to review, revise, and you have to go through in more detail of this IFRS for your understanding, for your complete clarification of this IFRS. Okay, student, it was a brief introduction of this complete chapter of your strategic business reporting. So, wish you all the best and keep watching for upcoming lectures. So, we are updating our lectures, and the next chapter will keep coming, and uh, very frequently we will willing to complete this revision and these recordings of lectures which are relating to 2025-26. So this is all updated, these are fresh recordings, so it is according to the syllabus of ACCA. Thank you very much, have a good day, and wish you all the best for your exam success.